Namaste. Today we are starting with a new chapter called cash flow statement. When a balance sheet is given to you before you, when you look at the balance sheet, you will find a corporate balance sheet having 2 years information. The first column will be the current year column and the second one will be the base year. So you will have 2 years information. Now a layman, when he looks at the balance sheet, he will look at 2 years figures. Oh, okay, fine. Current year plant and machinery had been this much. Oh, base year this was the amount. That's all. Fine. Well, layman approach will look into that okay, fine, there is an increase in machinery, increase in land. Oh, cash is reduced. This will be a layman approach. But from the accounting point of view, we cannot just like that take it. We have to now go in for analyzing the relative inflows and outflows of cash and cash equivalents due to the three major activities of any business called operating, investing and financing activities. So, we shall be preparing a statement called cash flow statement in which we are going to analyze the relative cash inflows and outflows due to the three major activities. Now, what is cash flow statement? A cash flow statement is a statement prepared to ascertain the inflows and outflows of cash and cash equivalents. What do you mean by cash and cash equivalents? Does not mean mere cash alone. Anything which can be converted into cash immediately are called as cash equivalents. Now, we shall be discussing about the examples of cash equivalents in later classes. Now, to ascertain the inflows and outflows of cash and cash equivalents due to the three major activities, namely operating, investing and financing activities. Why should cash flow statement be prepared? To know the sources and applications of cash and cash equivalents. What do you mean by sources and applications? Now I go back to the example I gave you. When we see a balance sheet with the 2 years figures, we only look at it and just say, fine, this is this amount, this is that amount. And probably little more investigation we shall be doing. Okay, from the base year to the current year, there is an increase in some of the assets, there is a decrease in some of the assets, some of the long-term borrowings have increased, some of the non-current assets have increased. This is a very general information that we are trying to infer from the given financial statements. But the accountant cannot leave the information as such. He has to go for consolidating the inflows and outflows of cash and cash equivalents to ascertain the sources from where the cash and cash equivalents were drawn and how were these funds applied, how were these cash and cash equivalents applied. Find the uses of cash and cash equivalents and then to find out the net change in the operating, investing and financing activities. Please remember, any change in one will have a series of impact on everything else. So, the objectives of preparing cash flow statement is to ascertain the increase and decrease or sources and applications of cash and cash equivalents and their usage and the net effect of this increase or decrease in cash and cash equivalents in operating, investing and financing activities. Now, what are cash and cash equivalents? Cash and cash equivalents are the ones which can be converted into cash anytime. So, the examples of cash equivalents may be checks in hand, marketable securities, then cash and bank balances, short-term borrowings or short-term investments also, then current investments unless and until they are specifically mentioned that they belong to non-current investments, it will be termed under current investments only. These are the ones which can be easily converted into cash and cash equivalents. So, the purpose of preparation of cash flow statement mainly lies in analyzing the relative inflows and outflows of cash and cash equivalents. Now, what are the advantages of preparing a cash flow statement? Number one, it facilitates ascertainment of cash flow. So, to know exactly where are the funds drawn from and how are these funds applied to ascertain cash flow. The next one, to facilitate planning. Financial planning is very much essential. Financial planning is the blueprint of any financial activities. So, for preparation of planning, for preparation of financial activities, it is very much essential. So, facilitates planning for the organization as a whole in terms of cash flow. The next one is helps in assessing liquidity and solvency. Liquidity is the ability of the organization to meet out its short-term obligations as and when they fall due. So, sundry creditors. Goods are bought on credit. Purchases, raw materials are purchased on credit. These suppliers have to be repaid in a short span of time, less than the operating cycle. So that means they are the current commitments which have to be repaid with the current assets. So to find out whether there is sufficient cash flow to meet out the short-term obligations as and when they fall due, cash flow statement is very much essential. Similarly, to meet out the long-term obligations also, purchase of machinery on a long-term deferred basis, issue of debentures which has a maturity period of 5 years and above. Fine, these are all the long-term obligations to be paid over a period of time. So, by preparing cash flow statement, the manager is able to foresee the probable cash inflows and cash outflows to know if the organization will be able to meet out its short-term and long-term financial obligations. So, it helps in assessing liquidity and solvency. The next is, it reflects, a good cash flow statement reflects cash efficiency of cash management. The preparation of cash flow statement facilitates efficiency in cash management, fund management. The next is, one of the tools for analysis of financial statements is comparative study. So, mere presentation of financial statements will be of use maybe for the students to score marks. But for the management accountant, for the shareholders, what is required is the critical asset test information on a table to know what exactly is the financial position of the company, what exactly is the cash position of the company. So, to facilitate comparative study, preparation of cash flow statement is mandatory. In fact, after the Companies Act has been amended in the year 2013, it is made mandatory that cash flow statement also should be presented to the shareholders in the annual general meeting. So, the 4 documents to be presented before the annual general meeting are the financial statements, namely the income statement, the position statement, notes to accounts and cash flow statement. All the 4 have to be presented to the shareholders in the annual general meeting. So, it is essential. It is a mandatory document to be prepared and it facilitates comparative study. The next is, it is facilitating a preparation of cash flow statement, facilitates cash flow position, reasons for cash position. What are the reasons why there is a change in the cash position at different levels, operating activities, investing activities and financing activities. The next is, evaluates management decision. Cash flow statement reflects whether the decisions taken by the management is in the right direction or not. So, investing activities will reflect the net inflow or outflow due to investing activities. Operating activities will reflect the increase or decrease in the operating activities. Similarly, financing activities will reflect net inflow or outflow due to financing activities. So, by just looking at the cash flow statement, the management can decide whether their decision is right or not. Next one is, preparation of cash flow statement facilitates the cash position in the organization. So, with the cash flow statement, the manager can decide whether the cash flow position of the company is satisfactory or not. to decide whether he has to go for declaration of cash dividend or plowback of profits. Then it also facilitates, we discussed already about what do you mean by solvency. Solvency is the ability of the organization to meet out its long-term commitments as and when they fall due. So, cash flow position facilities capital budgeting decision also. Capital budgeting decision, we know pretty well that is a decision about investment of funds in long-term projects. So, if the cash flow position is satisfactory, the manager can consider employing more funds in long-term projects. So, cash flow statement facilitates capital budgeting decision also. Now, coming to the flip side of it, the limitations of cash flow statement. Number one, it takes into consideration only cash position. So, cash flow statement is prepared using only cash basis of accounting, which is not an approved scientific method. So, by which what happens is, it ignores all non-cash transactions. So, that is one drawback. So, those transactions which have a strong impact on the business, like depreciation and bad debts provision, etc., are all ignored in cash flow statement because it does not involve cash inflow or outflow. The next one is, it is not a substitute for the financial statements. So, preparation of cash flow statement does not indicate profitability of the business, does not indicate the financial position of the business. It only reflects the cash flow position. It only reflects the inflows and outflows of cash and cash equivalents due to the three major activities, namely operating, investing and financing activities. Therefore, preparation of cash flow statement cannot reflect the profitability of the business nor the financial position of the business. So, preparation of cash flow statement does not replace the financial statements. It is in fact, with the preparation of financial statements, cash flow statement is prepared because cash flow statement draws its input only from financial statements. Because of that, what happens is, it is only historical in nature. So, when we say financial statements are only post-mortem of what has happened, cash flow statement is a further post-mortem of what has happened because we are only drawing the input from the financial statements. So, it only says about what has happened in the past. It does not say what is going to happen in future. So, it is only historical in nature. And we know pretty well, past ceases to be a guarantor for future. So, that drawback is also there as far as cash flow statement is concerned. And accuracy of cash flow statement depends upon accuracy of financial statements. So, if the financial statements contain some misleading information or misinformation, that means it is going to be reflected even in cash flow statement. So, what happens now if the financial statements lack accuracy? Obviously, cash flow statement also it will be lacking accuracy. That another problem is also there. So, accuracy of cash flow statement depends upon the information that is being supplied to cash flow statement. So, that also is a drawback for cash flow statement. The next one is, assessment of liquidity does not mean only by cash flow position. There are so many other factors. When we say liquidity of the organization, we take into consideration sundry debtors, marketable securities, bank overdraft, so many other factors. That being the case, mere cash position alone cannot reflect liquidity of the business. Liquidity of the company depends upon other factors also. So, these are the various drawbacks of cash flow statement. So, let us revise what we learned today. Now, cash flow statement is a statement prepared to ascertain the inflows and outflows of cash and cash equivalents. That means the real cash position plus the cash equivalent, which can be converted into cash anytime the accountant wants, the business wants. Fine. Due to the three major activities, namely operating activity, investing activity and financing activities. Now, the objectives of cash flow statement. Cash flow statement is prepared to know the sources from where the cash is drawn. Cash and cash equivalents were drawn, and the applications of them into various activities, namely operating, investing and financing activities. Then, to know the net change due to the inflows and outflows of cash and cash equivalents, the net change that has taken place in operating, investing and financing activities. Then we discussed about what do you mean by cash equivalents or what are cash and cash equivalents. So the examples are checks in hand, marketable securities, that means the securities in shares, say debentures, etc., which can be converted into cash easily. So marketable securities, cash and bank balances, short-term borrowings and current investments. In fact, after the amendment of the Companies Act, short-term borrowings are considered to be a part of financing activities. Then current investments. Any investment which is not a part of non-current investment will be considered to be current investment. Now, the advantages of preparing cash flow statement. Cash flow statement facilitates ascertainment of cash flow. So, it reflects the inflows and outflows of cash and cash equivalents. It facilitates planning. Proper cash management, cash planning can be done if there is a cash flow statement. Then it helps in assessing liquidity and solvency. Liquidity means the ability of the organization to meet out its short-term obligations as and when they fall due. The payments which have to be made in less than the operating cycle. Then solvency of the organization is to meet out its long-term commitments. So preparation of cash flow statement facilitates ascertainment of liquidity and solvency of the business. Then it facilitates efficient cash management. Proper cash management can be done if there is proper cash flow statement. Then cash flow statement facilitates comparative study. So comparing between the same organization of the previous year and the current year, or between one organization and the other organization. Fine. The next one is reasons for cash position. To know what is the reason due to which there is an increase or decrease in cash and cash equivalents. Then to evaluate the decisions taken by the management, whether they are going in the right direction or not, cash flow statement is very helpful. Then it facilitates dividend decision. Manager is able to decide how much to declare in the form of dividend and how much to plow back with the help of a proper cash flow statement. The next is for the management to facilitate capital budgeting decision. To know whether the money can be invested in long-term projects or not, cash flow statement is very much essential because the cash flow statement shows the projected inflows in future. Preparation of budgets can be done with the help of cash flow statement. So, the manager can decide in how many years will this project start yielding returns. Accordingly, the cash management can be done. The limitations of cash flow statement are, number one, it ignores non-cash transactions. Cash flow statement takes into consideration only the cash inflows and outflows due to operating, investing and financing activities, cash and cash equivalents, which means it follows only cash basis of accounting. Therefore, non-cash transactions which have a strong bearing on the financial position of the company are completely ignored. That is one biggest drawback of cash flow statement. Cash flow statement is not a substitute for financial statement. Cash flow statement reflects only the cash position. It does not reflect profitability nor financial position. And in fact, cash flow statement is prepared with the input from the financial statements. Therefore, cash flow statement cannot replace financial statements. The next one is cash flow statement is historical in nature because it is only prepared with the information which have already happened, with the business transactions which have already happened. So, it is only a post-mortem of what has happened in the past. It does not reflect what is going to happen in future. The accuracy of preparation of cash flow statement depends upon the accuracy of information supplied by financial statements. So, that is also one doubtful factor here. Similarly, assessment of liquidity, one of the advantages cited about cash flow statement, is also cannot be accepted fully because liquidity position of the company does not depend upon cash position alone. It depends on so many other factors, the efficiency with which other current assets are managed, so many other factors. So that being the case, assessing the liquidity of the position with the help of cash flow statement cannot be fully agreed. So these are the things that we discussed today in theory concept. The next class, we shall be discussing about examples of operating, investing and financing activities and preparation of cash flow statement as per Accounting Standard 3. Now, we shall be discussing about the various activities. We know that cash flow statement is a statement which is prepared to ascertain the inflows and outflows of cash and cash equivalents due to the three major activities, namely operating activities, investing activities and financing activities. Now, we are going to classify the operating activities, investing activities and financing activities. Let's know the meaning of operating activities, meaning of investing activities and the meaning of financing activities. Then we shall classify the inflows and outflows in investing activities, operating activities and financing activities. Now, what are operating activities? Operating activities are the principal revenue yielding activities of an enterprise. It's a very important aspect that we have to know. What do you mean by operating activities? The core activities, the fundamental activities, the very purpose of existence of the company is for the operating activities. So, they are the major or rather only revenue yielding activities of the enterprise. To know what are the operating activities, we shall broadly classify the companies into financial companies and non-financial companies. Financial companies are those companies wherein the principal revenue yielding activities deal with financial activities. So, proceeds of issue from debentures, then mutual fund companies, non-banking financial companies will all be classified under financial enterprises. For them, purchasing and sale of financial instruments become their core activities or fundamental activities. So, the operating activities of a financial enterprise deal with acquisition of financial securities, investment of funds in mutual fund, their portfolio management, etc. So, the revenue yielding activity is in the form of interest paid, interest received, dividend received, rent received, that way. So, everything connected to finance aspect of a financial enterprise will be classified under operating activities. Similarly, for a non-financial company, all those activities in which the company is engaged in will come under operating activities. So, for a hotel, for example, a hotel. For a hotel, hospitality management. So, room rent, sale of refreshments, sale of food items, etc. will come under operating activities. For a real estate business, purchase and sale of land, building, letting out of the property will all come under operating activities. Then, for an ice cream factory, so purchase and sale of ingredients and the finished product of ice cream related will be coming under operating activities. For an iron and steel industry, acquisition and sale or purchase and sale of iron and steel or steel related products or machinery, that way will come under operating activities. So, all those activities which are primarily revenue yielding activities will come under operating activities of an organization. So, I repeat, what do you mean by operating activities? The core revenue yielding activities are called as operating activities of the organization. To know what is an operating activity, first we shall be classifying the company into financial and non-financial companies. Financial companies are those companies which are involved in buying and selling of financial instruments. So, financial instruments like shares, debentures, bonds, etc. So, for a finance company, investment in securities, shares, debentures, receipts for in the form of dividend or in the form of interest will all be coming under the primary revenue yielding activity. The non-financial companies are the general ones which we come across. Any type of company other than the finance company are called as non-financial enterprises. So, for a hotel industry, the revenue yielding activity, the principal revenue yielding activity will be in the form of sale of food items, beverages, etc., or room rent, then the hall rent, etc., will come under principal revenue yielding activity. For an industry, production and sale of goods and services, goods will become the primary revenue yielding activity. For a transportation company, letting out or running of the fleet of buses, etc., the revenue realized out of that becomes a principal revenue yielding activity. So, now coming to next one to be investing activities. Investing activities are those activities which involve acquisition and disposal of long-term assets. Now, what are the investing activities? Examples of investing activities will be purchase and sale of non-current tangible assets. So, purchase and sale of fixed assets, purchase and sale of land and machinery, land and buildings, furniture and fittings, etc. will be a part of investing activities. The next is purchase and sale of non-current, that is intangible assets, non-current intangible assets in the form of goodwill, patents, copyrights, etc., intellectual property. Then, purchase and sale of non-current investment, that is long-term investments. Other than that, rent received, dividend received, interest received will all be a part of investing activities. The third category is financing activities. The financing activities are those activities which result in size and composition of owners' funds and borrowed funds. So, the financing activities are the main inflows, the inflows of funds for meeting out the operating and investing activities. Now, what are the examples of financing activities? Proceeds from issue of shares, equity shares or preference shares, by which there will be inflows. Then, proceeds from issue of debentures. Then, repayment of bank loan. We can include borrowings from bank. Borrowings from banks, then proceeds from issue of debentures, repayment of bank loan or long-term borrowing, then redemption, that is repayment of debentures or preference shares, then buyback of equity shares. This is all the after the amendment of Companies Act. Buyback of equity shares, then dividend paid. Please remember, dividend paid will always be finance activity for any type of enterprise, whether it is a financial enterprise or a non-financial enterprise. When will the company pay dividend? Only for the shares which the company has issued. That means the company cannot pay dividend for the shares which are bought and sold for other companies. When the company issues its own shares, only for those shares the company will pay dividend. Therefore, dividend paid is always a financing activity for any enterprise, be it a financial enterprise or a non-financial enterprise. Then, increase or decrease in short-term borrowings in the form of bank overdraft and cash credit. Then, interest paid. All these things will be classified under financing activities. So, let us revise what will we discuss in this topic now. We discussed about the classification of activities while preparing cash flow statement, namely operating activities, investing activities and financing activities. Operating activities are the fundamental existence of the business. They are the principal revenue yielding activities. The principal revenue yielding activity depends upon what type of enterprise is that. Financial enterprise or a non-financial enterprise. For a financial enterprise, their very purpose of existence is to deal with financial instruments. Therefore, for a financial instruments, purchase and sale of financial securities, financial instruments become their fundamental revenue yielding activity. For a non-finance company, the fundamental revenue yielding activity will be the core activity. That is the main purpose of starting the business. So, that will be their revenue yielding activity. Then, investing activities are those activities which are involved with acquisition and disposal of long-term assets. The examples of investing activities will be purchase and sale of intangible assets, tangible assets, that is fixed assets, tangible and intangible, purchase and sale of long-term investments, then rent paid, rent received, dividend received, then interest received will all be classified under investing activities. The last one is the financing activities, which deals with the activities which result in size and composition of long-term funds in the form of owners' funds and long-term borrowings. Now, examples of financing activities will be proceeds from issue of shares, equity shares or preference shares, due to which there is inflow of funds. Proceeds from issue of debentures, again inflow of funds. Borrowed loan, that is mortgage loan, due to which there is inflow of funds. Now comes the repayment portion. So, repayment of bank loan or long-term borrowing. Redemption, paying back of debentures or preference shares. Buying back of equity shares. Increase or decrease in bank overdraft or cash credit. Then dividend paid, interest paid, all these things will come under financing activities. So, in the next topic, we shall be discussing about the format of cash flow statement prepared as per Accounting Standard 3, revised, issued by the Companies Act of 2013. Namaste.